Coming up in today's show, stocks finished the day higher after comments from the Fed. S&P says the Fed's likely to hike next month. Wall Street forecasts for next year. Gold's approaching all-time highs. Tesla is set to launch the CyberTruck this Thursday. And Charlie Munger passes away. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I'm your host, Jared. Thanks very much for tuning in today, and apologies in advance to my regular viewers. This is the only show I'll be able to do this week, as I have to travel tomorrow for a few days on some unrelated business. However, I'll be back at the desk next week for the regular scheduled show, Tuesdays through Friday every night. And it looks to be a quiet time in the markets anyway. Apart from a few isolated moves up like Tesla, the rest of the market pretty much finished flat. And we can see that in the S&P 500 coiling up again, only trading in a small 28-point range today. And we're kind of just hovering above this resistance zone where we last turned back at the start of September, and we could be setting up a little bit of a bearish divergence here, or at least coiling up for a breakout, potentially to new highs. However, we may also come down and test this prior resistance and see if that can turn into support just above 4,500 there. But stick with me because we'll come back to the charts a bit later on. So what helped markets a little bit today was remarks from Federal Reserve Governor Christopher Waller, who's normally considered a bit of a hawk, came out a little bit dovish and said he sees slowing momentum in the economy, and even said central bank policymakers have been attempting to achieve that in order to bring inflation back down to their 2% target. In his remarks titled "Something Appears to Be Giving," he said recent economic data indicates the states is finally starting to experience a cooling labor market, slower consumer spending, and a significant moderation in economic activity. But he also said, "I remain willing to support raising the federal funds rate at a future meeting should the incoming data indicate that progress on inflation is stalled or it's insufficient to bring inflation down to 2% in a timely way." And so we're getting a bit of mixed signals coming out from the Fed itself. And now we've got some, like big research investment company S&P Global, saying falling bond yields help make another Fed rate cut likely next month, but expect a quick pivot to cuts next year. They're saying the Fed will hike rates by 25 basis points next month, as falling treasury yields are no longer a constraint on financial conditions, but that the Fed will have to quickly pivot as the impact of higher rates wears down on the labor market. And this is quite a bold call coming from S&P Global, and it's not something the market is really factoring in a big way. And we'd likely need to see oil and inflation really uptick over the next couple of weeks for that to happen, because as it stands, Fed fund futures are only pricing in just under a 4% probability the Fed will hike when they meet for the last time in 2 weeks. Otherwise, the market's pretty much saying the Fed's done and they should be cutting come May. And just looking at the price action in the 2-year government yield, that looks like it thinks the Fed's going to cut in a few months as well. And still seeing a lot of volatility with it falling 15 basis points today, down to a multi-month low. Same deal with the 10-year, falling today to 4.32 at the bottom of this support zone I've got in. And so back here, a lot of the market was saying that the bond market is doing the Fed's job for it in creating tighter financial conditions by increasing the cost of capital. But now S&P Global's arguing that the bond yields have fallen back. The Fed has to step back in again and create those tighter financial conditions to ensure inflation keeps heading down to 2%. And just looking out to next year, what the forecasts from Wall Street are for the S&P 500, they're bracing for below average returns after a forecast-defined 2023 rally. And just looking at 9 Wall Street firms, what their 2024 end-of-year S&P 500 target is, coming in the most bullish is Deutsche Bank, BMO Capital Markets at 5,100, and most bearish is Morgan Stanley and Wells Fargo coming in at 4,500 and 46.25 on the S&P, with the average target being 48.36 and the median being 4,800. So just looking at a clean weekly chart of the S&P 500, we've got forecasts from 4,500 being the most bearish, which is just 54 points below where we are now, all the way up to here, 5,100 is the most bullish target, with the average being at 4,800, somewhere around here. So on a whole, Wall Street is expecting the market to go up somewhat next year, currently just under 10% on average is what the street is expecting. And one of the most bullish out there, BMO, is saying that S&P will jump 12% to fresh record highs next year, even if we get a recession. And that's Brian Belsky, who said falling inflation, falling interest rates, and a strong jobs market will act as tailwinds for stock prices. And they're the one with a target of 5,100 based on earnings per share of 250, which gives the price to earnings multiple just over 20, implied earnings yield of 5%, which is not too bad if bond yields keep falling below 5%. And that's kind of the way the stock market is trading as well, that the Fed is done, rates are falling, earnings are holding up pretty good. So those earning yields should keep increasing. And if AI can accelerate earnings in the tech sector, then that helps the picture out even more as well. So even though we got some dovish comments from a Fed governor today who's saying he's seeing cooling signs in the economy, Consumers are still whipping out their credit cards to go shopping. We saw that in Cyber Monday spending, which set a record as US shoppers spent $12.4 billion online on Monday, and that's 9.6% above last year according to Adobe Analytics. And that surpassed their projections as well. In fact, in the peak hour between 10 a.m. and 11 a.m., Eastern consumers spent $15.7 million a minute. That's on the back of a good Black Friday and the weekend, where shoppers spent $10.3 billion on Saturday and Sunday, which was a 7.7% increase from the previous year. And they spent $9.8 billion on Black Friday, a 7.5% jump. So overall, Cyber Week brought in $38 billion. That's up 7.8% year over year. That's a pretty good increase considering what's been a high rate environment this year. And helping that is the trend of consumers using buy now, pay later options, which also reached a record high, contributing to almost $1 billion just in Monday sales, and that's a huge 43% surge from last year. So whilst that's good now for retailers helping to clear out their inventory and report good quarters when we hear from them next, it's not the most healthy organic increases, as it's coming from a lot of that high-rated pay later payment methods, which is contributing to the overall year-on-year increase. In total, US outstanding credit card debt just before COVID hit was $848 billion, and that was also back when rates were much lower, near rock bottom, especially going into COVID. Then there was a lot of stimulus and savings in the economy, and credit card debt actually dropped down to $737 billion come April 21. Since then, it's absolutely exploded to over $1 trillion, up over 50% in a little over 2 years. And so if rates haven't topped out, then the consumer, along with many businesses, are very vulnerable and exposed here. And just like one of the world's biggest investment banks, chairman of UBS, says a private credit bubble could lead to the next financial crash. He warned a single incident could spark a crisis in confidence that leads to a major crash, going on to say there's no doubt there's an asset bubble going on in private credit. You're seeing leverage building up. He also said there are many other asset bubbles building that pose a significant risk, mentioning commercial real estate as well, with one research firm saying the stock market could plunge as much as 27% when the economy finally tips into recession. That's BCA Research, which says the S&P 500 could soon face its worst crash since 2008. That's because the US economy remains on track to enter a recession as high interest rates take a toll. And if they are right, now could be a good time to buy insurance, as insuring a portfolio of stocks against a market crash hasn't been this cheap in years. And that's market strategists at Goldman Sachs and UBS Global Wealth who are pitching cheap portfolio hedges to clients. Goldman Sachs said the cost of buying a put option on the S&P 500 index that is 3% out of the money is just 34 basis points, the cheapest in the last 5 years. And UBS went on to say, while we expect a positive outlook for major asset classes over the coming year, risks remain and hedging opportunities look attractive. And we can see that in the volatility index, with the VIX at a very low 12.7, even though actual realized volatility in the market's 13.4, meaning that volatility risk premium is still negative. Option dealers are willing to sell premium for volatility prices below the actual volatility in the market now. In other words, they're forecasting volatility to keep trending down in the market. However, the VIX curve is a little steep percentage-wise because we've got the VIX at 12.7, then almost 3 points higher is the VIX 3-month, and again, the VIX 6-month at 17.8. So options further dated out are always, most of the time, more expensive, as it's more likely we'll get a VIX spike in the next 6 months as opposed to the next month. So there's always an inbuilt premium for insurance further out. However, with the VIX 3-month at 15, that's still pretty low. And so the cost of 3 to 6 month at the money or slightly out of the money put options is pretty cheap here. However, you'll still pay up for those far out of the money put options. We can see that in the skew index, still at 142. So you can't buy crash insurance really cheap here. However, the more closer to the money the options, the cheaper they are right now. Moving on to commodities, we've got oil ticking up again as we're awaiting the OPEC Plus meeting, which was delayed, but was supposed to happen over Sunday. They pushed it back and that spooked the market a bit, signaling that they're not all on the same page with their desired production cuts coming out from the Saudis and some African nations not wanting to do that. They want to keep pumping it out. And so they're going to have an online meeting on Thursday, and we'll see if the group shows some unity, come out on the same page, or the Saudis may want to make it up by doing more of their own production cuts. And so the way the oil market had been going was some building supplies and pulling back demand at a time of record production coming out of the States, the number one producer in the world. The Saudis and the OPEC hold that swing factor card, and if they come out with some deeper production cuts, we could see oil moving back up above $80 a barrel in no time. However, they weren't all able to get together on the same page, then we could take out this support as well and trade down to 70, the high 60s, where I'd expect we'd find support again. So I'd expect crude to coil up going into Thursday night. And here we are once again, gold pushing up against all-time highs above $2,000 an ounce. And helping the shiny metal is a weakening US dollar as Treasury bond yields have pulled back. Gold has risen, trading up in a really strong short-term uptrend here, currently at $2,060 an ounce. And just taking you out to a weekly chart, that's really close to all-time highs of $2,089 an ounce. And so this could be the moment that we've been waiting for all year and we thought was going to happen back in May. After literally only getting $4 within those all-time highs, then we pulled back on the back of that strong dollar. We found really good support just before the conflict in the Middle East. Kind of done a really good bounce from there, and we're sitting right up against these all-time highs. So we'll have to see whether we can get a clean break through 2100 over the coming days and weeks. And that's certainly helping gold mining stocks, the winning sector today, up 4.8%. And just as you can see here on the weekly chart, gold miners have been significantly underperforming the gold price itself. And typically the miners are a high beta play on gold, especially the junior miners under the ETF GDXJ. If gold's going down, then the junior miners will get hit harder. And if gold goes up, then typically, looking back in history, the junior miners will outperform as well. And we could draw a big trend line on the last 3 years of price action, and a solid clean break above that on the junior gold miners could be a good play if we see gold make a run above 2100, as there's still a lot of good value to be found in this sector and individual names. Moving on to crypto, we've got a really bullish forecast coming out of Standard Chartered saying Bitcoin's well on its way to hitting 100,000 by the end of next year as crypto spring has begun. The token has increased its share of the digital asset space while miners are selling less, and the increased likelihood of a US spot ETF has been a positive surprise for the market, and that's definitely been the bullish catalyst this year. Filings from BlackRock, Fidelity, and other large investment houses to get spot crypto ETFs on the market help legitimize the asset and pave the way for big institutional money to come in the space. And the crypto market has been front running all that money for a few months now. And there's a look at the daily chart of Bitcoin. Still on this bullish pattern, still got a green wave flow showing the short-term trend has persisted. We've only had these really minor quick shallow pullbacks. We seem to be holding that 36,000 level as new support, and looking really likely we're going to make a stab at 40,000 over the coming days and weeks. And Bitcoin's been one of the best performing major assets this year, up over 100%. Ethereum hasn't done quite as well, but is holding up near its resistance zone as well. Big event this week, we've got the launch of Tesla's CyberTruck, which has been long awaited, come with a few delays and hiccups, and they're scheduled to go on sale this Thursday. And Elon Musk has already warned there'll be challenges to reach in volume production, and we'll get to hear more on Thursday, 3 p.m. Eastern time, when they're holding an event at their Austin, Texas factory, and they're going to deliver the first 10 Cybertrucks to customers, calling the event Cyber Thursday. And Tesla stores across the country have already started displaying Cybertrucks over the weekend, drawing in crowds and creating a bit of buzz as the company's trying to get that halo effect from the vehicle, which spills over to other products. And the market will really be hoping that this could put a bottom in for Tesla's gross margins, which have been pulling back as they've cut prices, and we've seen huge falls in the average resale value of used Teslas. And so hopefully the Cybertruck can keep up their huge growth rates as well as defend their operating margins. And the market seems to be getting a little excited with that, with shares finishing up 4.5% today on really good volume. And Tesla stock never ceases to amaze me with its resilience just to hold up. Even after its bad recent quarter, it fell. Margins came in a lot worse than expected. They disappointed on estimates, and so I was a little surprised to see it reclaim this gap in quick fashion. However, we had had the stock market bounce back really good the last couple of weeks, and it's not really surprising going into the launch of the Cybertruck that the market can get a little excited here. And so if the launch goes well and we hear some good numbers with their ability to produce and an idea of what margins they're going to deliver, and the market continues to hold up, then very well Tesla could make a run for 300 again over the coming weeks and months, driven from the buzz of the Cybertruck. And finally in news today, we just heard that Warren Buffett's right-hand man, Charlie Munger, passed away at the age of 99. And so Charlie's kind of always been the voice in Buffett's ear. They've been partnered for more than 50 years. And him and Buffett started off by running their own investment partnerships, kind of like private hedge funds themselves. And Buffett was more into buying cigar butts. He'd buy any business as long as he could buy it below net liquidation value, which is kind of the Benjamin Graham way of investing, and what they'd call picking up cigar butts, which were good for just one or two more puffs. Whereas Munger was more focused on buying quality businesses at a reasonable price, and he eventually convinced Warren Buffett to do the same, helping him buy businesses like Sea Candies and building a huge position in shares of Coca-Cola in the 80s, for which the company Berkshire Hathaway still holds today. And so he had a huge influence on Warren Buffett and how Buffett invested, and I've learned a bit from Charlie Munger as well, reading his teachings over the years and listening to him in interviews. He helped convince me that the way to go about investing is just to hold a couple of key concentrated bets in a long-term portfolio outside of trading. So instead of holding 30 or 40 stocks, which like he said pretty pretty much makes you a closet indexer. You might as well just buy an ETF. He'd always say you only need 3 or 4 good positions to have plenty of diversification, which I agree. And himself, most of his life, only held positions in 3 companies, with Costco being one of his favorites. And so he was one of the best investors of all time, had a great mind, shared his knowledge, and did some good charitable work as well. So rest in peace, Charlie Munger. Moving on to economic data we got today, the Case-Shiller home price up 3.9% year over year. We're going to get some CPI data from Australia shortly. Looking out to tomorrow, we're going to get some more CPI data from Germany and a look at GDP growth rate coming out from the States. Going into Thursday, we'll get some more inflation data coming out of the Eurozone, GDP growth from Canada, and some PCE and personal income data from the States. Finishing out the week with GDP growth coming out of Switzerland and some manufacturing PMIs from the States. Got the Fear and Greed Index still sitting a little elevated here at 65, and corporate insiders seem to have significantly pulled back their buying, only showing 57 purchases yesterday. And just looking at my institutional buying percentage indicator, that's a little bearish here, sitting at 41%, and the S&P 500 oscillator just below 61 and turning back down. And stick with me to the end of this video, I'll give you my final thoughts on the S&P 500 and where I think we go from here. Just looking across other financial markets, looks like we're in for another sleepy week. International stock indices really flat this Tuesday. We've already had a look at the VIX, which is still really low. And then mega cap tech still holding up the indices really well, along with high beta stocks and growth versus value. And we can see that in the spread of consumer discretionary stocks versus consumer staple sitting near yearly highs as well. And as the spread of inflation expectations continuing to tick down, pullback in yields is helping bond ETFs like TLT continue to tick up higher, and got a pretty nice breakout here on high yield bonds, coming back up to highs we didn't see since July, and a strong sign of improving risk sentiment in the market, and also helping stocks is the falling dollar, breaking down again today to 102.6, which is helping to give commodities a boost, with copper trading back up and other softs like orange juice continue to trade really strong. Looking across stock sectors, had a bit of a move up in meme stocks today, along with ARK, the really high beta, volatile, overvalued stocks trading really well this last couple of weeks. And many other sectors pretty flat, industrials, financials, and energy, all pretty much finishing the day unchanged. And there's the daily chart of gold miners. A lot of volume coming back into this space and really nice breakout here. And looking at my indicators, even though it's above the buy sell band and a reversal signal, I wouldn't fade that. I wouldn't short that, as that looks like it could be a clean breakout. And some yielding sectors like utilities and dividend paying stocks continuing to hold their bullish formations as well. Along with the BlackRock barometer trading really strong. JP Morgan still the strongest of all the banks, and mega cap tech just holding up there. Apple and Microsoft once again, another day, another all-time high, and Nvidia just pulling back a bit from those highs just above 500. Still got Intel trading strong, sitting near highs, and just had General Motors close above its 50-day VWAP for the first time in months. May have put a bottom in a few weeks ago. And Walgreens trading down just below $20 a share, and we may not have put a bottom in this just yet. And with those beaten down telecoms, Verizon holding on pretty good up here, and a little bit of mixed action in the regionals and other big banks. Okay, back to the S&P 500. We're starting to flatline a bit on the DSI and fall a little bit on the hidden divergence. It was mega cap tech, the winning group again today, up almost 1% and kind of consolidating near their highs, along with the NASDAQ as a whole. Kind of traded up in this strong pattern, and now we're just coiling up on really low volatility, which often precedes a breakout, which could come in either direction. However, since we've still got volatility risk premium negative, so the odds are still skewed for the upside. Thursday's the last day of the month in November. Friday's the new month of December, which is typically a bullish month as well, especially if we already had a good year. I still think it's likely the S&P 500 maybe this week could come up and peak its head above yearly highs at 46.07, where I think we could make a short-term top around 46.30, 46.40, and that's still pretty much a directional 500-point rip in the S&P. Now, if oil and inflation data keeps coming down, we just had a good Q3 earnings season. Breadth is starting to improve. We've got a lot of sectors and stocks making some strong bottoms, putting in some strong volume, getting back above the 50-day VWAP. Looking at my trend signals indicator, that's gone back into buy mode on the equal weight 500 as well. My market risk on risk off indicator has been back in risk on mode since the 30th of October. And looking at my sector trends table indicator, we've only got 3 sectors below their 50-day average. That's energy, oil and gas, and clean energy. Apart from that, the medium-term trend in most sectors now is bullish. So the momentum and the odds are to the upside. However, we are 5% above the 50-day VWAP. And like we can see in my sentiment indicators, we're a little technically overbought. So we're due a little pullback here. But for now, we're in a really calling up low volatility environment. We'll just have to see which way we get that breakout. That's all I got for you today. Apologies once again, this is the only show I can do for this week. I have to travel for a few days to another city. However, I'll be back next week for the daily show Tuesday through Friday. Thanks very much for all your support, and I hope to see you again next week. Cheers.